You can pay your kids $16,100 this year, completely tax-free, zero federal income tax, zero FICA, if your business is set up right. And here's the part that should blow your mind. That money can go straight into a Roth IRA account, and by the time your kid retires, it can grow over $1 million, completely tax-free forever. This is one of the most powerful tax strategies in the IRS code, and most business owners have no idea it exists. In the next 9 minutes, I'm going to show you exactly how to set this up the right way without getting audited. Here's what we're going to cover. First, the basic mechanics. Who qualifies, how much, what the kid actually has to do. Then I'll walk you through the simple setup process for LLCs and sole proprietors, including the part most CPAs on YouTube completely get wrong. Then the workaround for S-corp owners, because the rules are different for you. Then the secret multiplier, how to turn this into 7 figures using the Roth IRA. And finally, the audit proofing, the documentation you need so the IRS can't touch you. Let's get into it. So here's the foundation. When your child performs legitimate work for your business, you can pay them. And because they're a dependent, they get their own standard deduction. So for 2026, the standard deduction is $16,100. So that means your child can earn up to $16,100 in wages from your business and owe zero income tax. Now, let's talk eligibility. The work has to be real, and it has to be age appropriate. And the wage has to be reasonable for the work performed. So a 6-year-old folding flyers in your office, that can work. But a 6-year-old as your CFO making $50,000 a year, that can get you audited. See, the IRS isn't stupid, but within reason, ages 5 and up doing legitimate tasks, there is a clear playbook for that. So like modeling for your social media, filing, shredding, cleaning the office, filming on TikTok. I've personally helped clients pay each of their 3 kids the full deduction every year, totaling to $48,000 per year, completely shifted out of their tax bracket and into their kids' tax-free zone. For a business owner in the 32% tax bracket, that's over $15,000 in federal tax savings every single year. If your business is a sole proprietorship or a single member LLC and you're the only owner paying your kids under age 18, it means no FICA, no Medicare, or no FUTA. That's a 15.3% additional tax savings. Gone. This is IRS Publication 15, black and white. Now, here's where I'm going to give you the honest answer most CPAs on YouTube get wrong. You do not legally have to put your kid on a formal W-2 payroll. The Internal Revenue Code does not require it for sole prop paying their own child. What you do need is real work performed, age appropriate, reasonable wages, and solid documentation like timesheets, job descriptions, dated payment records, and the payment deducted on your Schedule C. If you're not running formal payroll, deduct them as outside services. If you're issuing W-2s, they go on line 26 as wages. That is the legal minimum. But here's the flag I want you to hear. Once you're paying serious dollars or stacking the Roth IRA strategy I'm about to show you next, the W-2 becomes the cleaner play. Not because the law requires it, because under audit, a formal W-2 is the bulletproof evidence of earned income. So, 6-year-old earning $2,000 a year filing flyers, documentation alone is plenty. 15-year-old earning $10,000 a year and funding a Roth IRA, I would advise to run a formal payroll. The W-2 makes everything cleaner. That's the decision tree. Now, if you're an S-corp, the rules are different. And this is where most CPAs leave money on the table. Paying your kids directly through the S-corp does not exempt you from FICA. Your kids' wages get hit with Social Security, Medicare, and federal unemployment, same as any employee. That kills a huge chunk of the savings. But here's a workaround. It's called a family management company. Here's how it works. You set up a separate sole proprietorship or a single member LLC owned by you personally, and that entity hires your kids. The family management company then contracts with your S-corp to provide management services. Your S-corp pays the family management company. The family management company pays the kids. And because the family management company is a sole prop owned by a parent, your kids' wages are now exempt. You just legally got the same outcome an LLC owner gets even though you're operating your business in an S-corp status. Now, this is more advanced. The family management company has to be a real entity with real services rendered, not a paper sham. The contracts need to be in writing. The work products need to be documented. In my 13 years as a CPA, this is one of the strategies I walk every S-corp client through during onboarding, because done wrong, the IRS will collapse the structure and treat it as a sham transaction. But done right, it's bulletproof. Okay, here's where it gets unfair. When your kid earns wages, they have earned income. That means they're eligible to contribute to a Roth IRA. The 2026 Roth IRA contribution limit is $7,500 per year for anyone under 50. So you pay your kid $16,100. Of that, $7,500 goes straight into a Roth IRA in their name. Now do the math with me. $7,500 per year invested at age 10 at a historical S&P 500 average rate of return of 10%. By age 65, that single year's contribution turns into roughly $1.4 million tax-free for the rest of their life. And if you do this every year for 10 years from age 10 to age 20, you're looking at well over $10 million in their Roth IRA account by the time they retire. You just funded their entire financial life by paying them tax-free money you would have paid in tax anyway. This is what wealth building looks like at the IRS code level. This is the strategy I run for every business owner family I work with. Now, here's the part where most people get this wrong. The IRS knows the strategy exists. They know business owners use it. And they audit it when documentation is missing. So here's what you need to do. 1, write a job description for each child. Real tasks, age appropriate. 2, timesheets. You gotta document hours worked, tasks completed, dated and signed. 3, you have to have a reasonable wage. So compare to what you'd pay an outside hire for the same work. 4, actual payment records. So money flowing from your business account to the kid's account. Consistent, just like any business. And for larger payments or when you're stacking the Roth IRA strategy, use a formal W-2 payroll setup for the cleanest audit trail. And 5, proof of work. So like save the examples like social media posts the kids filmed, files the kids organized, photos of the kids working. If you have those, this strategy is bulletproof. But if you do not, you're playing roulette. See, the IRS does not care that the strategy is legal. They care whether you can prove you did it right. So look, paying your kids correctly is one of the highest leverage tax moves a business owner can make. It legally shifts income out of your highest tax bracket, it funds your kids' future, and it gives them a tax-free retirement that compounds over 60 years. But the setup matters. Sole prop is one playbook. S-corp is a different playbook. The family management company has its own rules. The Roth IRA timing matters. The documentation has to be airtight. This is exactly what we do at HK Financial Advisory. I'm Henok. I'm a licensed certified public accountant, and we help business owners build family tax strategies that legally save 5 and 6 figures every single year. If you want to know exactly how to set this up for your situation and run the actual numbers on what it would save you, book a free strategy session with us. The link is in the description and pinned in the comment section. Do not leave money on the table. I'll see you on the next video.